Welcome to the Money Pickle podcast, where you can listen and learn about money without falling asleep. And if you need a better understanding of your financial situation, or maybe you just want a second opinion, head to moneypickle.com, where you can schedule a free 45-minute virtual appointment with one of our experienced professionals. And with that said, let's dive into the episode.
All right, welcome everybody to the Money Pickle podcast. You're joined by two Pickle Pros, Mason Goris
and Brandon Moore here.
Got Brandon Moore, and we're going to talk about a couple things today. Some questions that we've gotten over the past, just few days, few weeks through Money Pickle, and some current events. But we're going to start off with how Brandon and I met, actually. Back in the, do you remember?
It was a stormy night in November.
That's right.
No, I'm just kidding. We grew up together. Went to grade school together. Went to similar colleges. Even though I was on the west side of the state, he was in the middle. But we ended up back at the same financial planning firm, and then we do not only that together, but also Money Pickle as Pickle Pros. So again, our background has always been money. I remember Mason was in call it high school. We were talking about what stocks we should be buying, or whether it's some medical marijuana ones at that popular time, or something different. We lost a good amount of money, I'm sure, there, but it's fun to see where the roots of all this has come from.
Yeah, absolutely, and it was specifically at the bus stop. I remember is where we technically first met. But okay, we've gotten a lot of questions about saving strategies, mm-hmm. right? And that's vague, right? Saving strategies. What should I be thinking about? Do's and don'ts. Some things. I'll kick it off and feel free to fill in some gaps. A lot of people ask about percentage of what they should save. Percentage of their salary. How much is good, or too much, or too little. I think we are the same as far as mindset goes on this, but what we really want to look at, first of all, more is better, right? I mean, saving more, investing more, it's going to, give you more nest egg at the end. But we do have a fair number of clients who are, we'll say, oversaved for retirement. That could be, and I think very much so, is another form of a retirement failure, if you will. You kind of, just sacrificed your whole life. Okay, great. You are financially very sound at the point of retirement, but health events come up. People are less mobile. You have a couple $1 million. What am I going to spend that on at this point in time? I can buy a really expensive lamp, but maybe I can't. And I'm serious, right? I have a client who I was talking with. They have it's called a Vanini lamp. It's like from Italy. It's like a $14,000 lamp, and that's great. That's all awesome.
Sparks your interest.
It's way better than my lamp at my house. But it again, another version of a retirement account failure. And what I really like to look at, and I do this for my own money as well. And tell me if you do this for your money. But I like to look at what my lifestyle is like right now, how much money I like to spend, and I essentially want to back into how much I should be saving. And what I mean by that is, if I want to spend whatever $4,000 a month now in today's dollars, and I have 20 years until retirement, we have to project forward how much money in future dollars is a $4,000 a month lifestyle now. With inflation, it might be $5,500, mm-hmm. Later on down the road, whatever. And we need to see, are we on track with current rate of savings or investing or 401k to be able to sustain our current lifestyle, which is $4,000 now, for example, $5,500 later. Are we on track to meet that? If that answer is yes, okay, with a modest rate of return, right, not over expecting anything, mm-hmm. that's kind of one way to back into it. And that just excludes what type of account,
right,
you should save into, obviously.
It really comes down to that balance aspect. I mean, when people are trying to approach saving and planning, we often see the two extremes. The person that has worked to this muscle so hard that they're honestly a little bit boring, and they didn't have any hobbies or goals or things that you had, like you said, outside, like the lamp or maybe something different. But beyond that, again, there's that other alternative, which is the person that simply is kind of living for today and not having a tomorrow. So they don't really have that definitive goals of what they need to do to recover that lifestyle, 20, 30 years from now. So what we try to do as financial planners and proper financial planning and coaching, right, is from finding us somewhere in the middle.
Right. Yeah.
Because we see it every day. We see life events, kind of like when doctors see people come into their practice that are sick, right? They kind of get a realization of, oh my gosh, we all have an expiration date, and so does our money is not good to us if we're not here. So
right.
So what can we do now to differentiate between saving, but also the term investing, right? I kind of like to be more specific on that because
good point.
When you hear saving money is one thing of many, right? You could put money into a bank account for the next 30 years and you're still saving money. But are you actually investing money? So one tip for anybody out there listening is make sure that when you say you're saving money, that's above and beyond your emergency fund, right? Is what you look at investing. You save enough to have some preservation and things you want to do in the bank, but other than that, everything else should be invested toward either a retirement accounts, other investment accounts, or things that would improve your standard of living years down the road.
Right. Yeah. Really good point. In its simplest form, I mean, investing, the goal, I guess, if you will. Yeah, everybody wants to build wealth. We're just trying to keep pace with inflation. In the most basic,
it's
right?
Very high right now.
It's
right?
very high right now.
You're trying to get a carton of eggs at the grocery store right now? It's like $6.
Yeah, I am almost about to quit buying pasture-raised eggs because those are like $9 now, and now it's we're getting up there. That's like what a case of Oreos is, and that they're just those two things are competing, and they never have before. We want to beat the rate of inflation, which historically is what, like 3% or so.
Yeah, on the high end, right? The Fed's targeting for what, 2, ideally?
Right. Yeah, exactly. And if we keep money, to your point, if we're just saving, if that's going in a bank account, yeah, we're preserving the capital, but what's really happening is we're losing money over time. Just keeping money in a bank account, I'm not talking CDs, which right now, the yield's a little higher, just 0% rate of return bank account, which still a lot of people have. We are losing money slowly. Yes, it's guaranteed, but we are guaranteed to lose, money slowly, if you will, unless inflation just, drops or whatever. It's just,
And one thing I think we've been talking to people about on the coaching calls is we've been seeing some people saying, oh my gosh, why would I not move money from an investment account that I have that's clearly down over the past year, right? The S&P 500 has been down over a full year now, right? And they say, well, why can't I just put it into the bank and get my fixed 4% or 4.5%? And our conversations are, okay, well, that's a great little return that you're going to get on that. It's actually a decent return in the long scope, but we know that those rates are not good forever. Right. So do you want to sell out of an investment at a loss and lock into something that's never going to earn more than a certain amount? Probably not a strategy that you want to employ if you're trying to create that wealth for a few more years down the road.
Right. Yeah. There's and that's a lot of obviously questions that we've been getting as well as I'm close to retirement. I'm kind of over exposed to stocks, right? I have like 90% of my 401k in stocks. Should I reallocate? Now is probably not the time to do that. There's a more optimal time to kind of take some chips off the table. If you are kind of, if you're exposed right now in the fact of, hey, we had all of our wealth, here we are approaching retirement, we're 3 years away, now our portfolio just got cut by 25%. That is very unfortunate, and that's a reality for a lot of people. So I'm not saying, coulda, shoulda, woulda. Nobody knows what's going to happen in the market. But, now when the market's down, to your point, might not be a good time to reallocate or even just, take it out and switch it to a guaranteed rate of return. Chances are we got cut by 20%. And now if we're just getting 4%, it's going to take several years, into a lot of people's retirement to just get that guaranteed, rate of return on a CD or something, or a lot of times it's variable, obviously, right? They change on us. That's just a hard route to go, decision to make. So
I know these conversations vary so much on our calls as Pickle Pro, as there are some people that are approaching that retirement stage, right? That are seeking this guidance or what to do, and it's a much more complex question when you're trying to eventually take money from a portfolio. But I would say probably about 80 to 90% of our calls, though, are people who are trying to build wealth, right? Mm-hmm. So I guess from that aspect, with the market being down over the past year, what an opportunity.
Yeah,
right?
Absolutely.
I mean, when have we, in the last 10 years, anyone who is maybe just starting investing who's calling in to get some coaching and some just general ideas of what money means, when do we want to go shopping, right?
Right.
When it's on sale. And not let ourselves be scared of the fact that the market's down. Use it as a point of leverage to continue to be consistent, not with just our savings, but our investing during the scary times, mm-hmm. right? Because what is it? What was it? Warren Buffett say? He says, when people are running away, you probably should run toward that issue. And when people
sure.
are going towards something that's saying you should invest in something, you might want to run away, right?
Right.
And so again, kind of do the opposite of what we've always been told, and it could often work out better.
Yeah, absolutely. Yeah, the way I see it, the market's down, and existing money that we've had has obviously been impacted by that. But all these $100 bills that we're just putting systematically into a 401k, or if we're going to make a IRA contribution for last year because the window's open until the tax filing deadline. These are some $100 bills that we might be really happy with. 6, 7, 8, 10 years from now that we got in at a really good time. On sale, and the average return on those are probably might be something that we're happy with.
Yeah.
So.
And one thing I want to talk about too is people get really confused about interest rates right now. Mm-hmm. It's a weird topic, right? Because interest rates doesn't necessarily mean rate of return, or doesn't mean anything of really relation to the stock market, other than how stocks are impacted by the cause of it rising in rates, right? Mm-hmm. So, I mean, I'm sure you're better than anyone, as we talked about it on the last call, but what is the Fed doing, and why can I get 4% in a savings account right now, and why is that actually hurting my stock portfolio?
Yeah, that's a really good question. The genesis of why interest rates are going up is to curb inflation, right? Theoretically, in a nutshell, forget about all these other factors in the economy, which obviously just muddies the water, but, hold all the variables constant. If we increase interest rates, inflation should come down a little bit. It's theoretically making money more expensive for the world. And, that translates into, less, just getting to your point about stocks, translates into, less business building, manufacturing. Ford Motor Company might pump the brakes on, taking out a lot of debt at a higher interest rate, building a new facility. So, it's trying to cool off the market, bring down the rate of inflation, which obviously we want inflation to go down. But, obviously in reality, does it, as we crank on interest rates, do we see inflation go down right away? No, we actually saw, interest rates rise and inflation continue to rise, throughout last year. And it's the long game. Inflation's going to be in our lives for a little while, still pretty high. And, I think longer term we'll get back to our averages. But yeah, it's good for, maybe our left pocket or bank account, because we get some higher rates that we haven't had in a long time. But at the same point, it's cooling off the stock market. It's contracting the market versus expanding mm-hmm. the market at the government level or at the macro level. And so it's kind of a benefit to left pocket, harm the right pocket, versus kind of where we just came out of, maybe benefit the right pocket, and the left pocket was getting zero interest rate. So, right. There's always pros and cons. It's never going to be everything's just going great. There's always a balancing act.
Yeah. So basically, you're telling me that a high yield savings account's not going to make me rich.
I mean, high yield savings accounts and CDs and bank accounts, they're not there to build wealth. They're there to preserve, right?
Mm-hmm.
Obviously if we're sitting at a 0% interest rate, and we could easily transfer it over to, whatever bank and get a higher percent interest rate. Well, you might want to go through the rigmarole of doing that just out of principle. It might only be a few $100s at the end of the year to the average person.
Right.
But not necessarily.
Right?
It's a difference.
It's enough to get something to keep up, but it's not enough to actually make a big difference based on everything's relative, right? Rates were completely relative to where the inflation was prior to, and we're not netting any more than we were, but we have to make sure we're taking some of the advantages of those accounts while we can.
Yeah,
right?
fair.
One thing I did hear the other day, though, about inflation, was put really nicely, was inflation is actually more dangerous when it's less advertised, right?
Yeah, good
Meaning
point.
everyone's so focused on it right now, right? Because it is very, very relevant, right? Because everything is more expensive. However, it's even worse when inflation is low, or call it 2.5%, 3%, and you don't think it's a problem. Right? Mm-hmm. So you're keeping more money in other accounts that aren't beating inflation or other things, and it's that silent killer that we've seen over time where at least now you're seeing something that's making people take some action, but before they didn't have to.
Mm-hmm.
They didn't think they had to, even though it was just as relevant in their overall financial plan.
Yeah. I think it indirectly might help some people, just kind of pump the brakes on their own personal spending and say, okay, I wanted this, pair of shoes or whatever, redo a deck in my backyard. Now that things are a lot more expensive, you kind of critically think. And, I do think a lot of people are taking advantage of the opportunity and, rather than just spending it on things that are now higher priced, they're saving and investing it, to our point in the market that's down,
And we see this every day. We don't have control over any of this, right? What the Fed's going to do, what the market's going to do, but what can we control? What we spend.
Right.
It's the easiest thing out there, right? It just takes more, sacrifice and a little bit of planning to know that if you're spending within your means, right?
Yeah.
And we know that if you are doing long enough, spending less than you're making and investing the difference, you're going to do very well financially in the future.
Yeah.
So
absolutely. How about what do you think about this whole Silicon Valley Bank in the news right now? I mean, what are your thoughts? Obviously, we talked about this as a team behind the scenes, but should the average person be worried, I guess, about their deposit at the local credit union or their local branch?
Yeah, and what a crazy time, right? But it's nothing that we haven't gone through before or seen before. People probably are kind of giving a little bit of flashback. Maybe not many people listening, but if you were experiencing around 2008, some of these things were somewhat similar, but nothing like this one-off situation. But to give anyone context, what simply happened was this bank, SVB, put too much of their own money, capital from their clients, into a treasury bond that was a 4-year-long bond, right? And that bond, again, only pays that rate of return if you're leaving it there for that period of time. If they're cashing it out sooner, well, they're not going to be able to get the full return on their investment, okay? And they on this bond, when they bought it, was back when interest rates that we just mentioned there were low. And that low rate environment, this was actually looked to be a great investment for them. However, they did what people know not to do, even just our general clients, right? They know not to put all their eggs in one basket, right? And this bank unfortunately did that. And that put their clients at risk when their bet against interest rates was wrong because they started going up, which caused the value of when they start pulling money out to go down, right? So they weren't able to cover their deposits or withdrawals that people were trying to pull out. But also something to note as well, this was also a bank that was very, highly participating in, hedge funds, higher net worth clientele, a lot of businesses, and I think it was like 89% of the deposits of some sort were over the $250,000 FDIC insurance limit.
Yeah.
I mean, that is not as common at a Bank of America, a larger corporate bank,
Sure.
versus like a regional bank like that. So, again, should we be worried about, as just general people, about our bank money? Again, I'm not too worried because I follow a couple different rules, right? What I personally do is I don't keep all of my money at one specific bank, right? That would be, for a couple reasons. First off, I use like a big bank for my in and out account because it's super convenient, right? And they're everywhere. and I use my high yield savings for my emergency reserves, right? And in neither account, not even close, but do they have less than more than $250,000 in there?
Right.
Right.
Yeah.
And so I know from right there alone, I am fully covered on the FDIC insurance limit, and I'm not concerned about, also even below that, I have not that much money and also in two separate banks. Right?
Sure. Yeah.
And so that's important for people to remember is that's your only way we can control this, right? Other than that, it's very clear that the Fed was a little bit lenient to be able to give them the right to bail out of this situation, which is a little bit kind of unfortunate, I think. But again, the only way we prevent this bank issue from happening, which it can happen at any time, right?
Yeah.
Meaning if everyone tomorrow, or disregard what just happened, went to the bank and pulled out all their money, there would be no banks left.
Right.
So what the government's trying to do is, again, you get to calm people down. It's going to be okay as long as no one freaks out and does anything super silly.
Yeah. Yeah, I think in a time like this, the economy is just front and center, and inflation. I think if, whether it's right or wrong, I think if the government didn't come in there and say, okay, it's all going to be fine, I think it would create a lot of panic, even though, yes, that is not your average bank. It's not your average clientele at the bank.
Mm-hmm.
The companies and the bank themselves, got caught in a bad situation, probably too much deposits at one bank, betting wrong on interest rates. So we'll again, and I agree with you. It's not a big concern from my perspective. I haven't pulled money out of my own bank.
No.
Put it under the mattress or anything.
No,
So
because you don't want a house fire and everything else to go,
right,
or someone to steal it, right?
Right.
Even worse than
Yeah.
the risk of having a bank not perform well for a period of time.
Right.
Right.
Yeah. Let's have some confidence in the financial system, if you will. It's not all just
Correct.
yeah.
Yeah. No one's out to get you. It's simply you have to make sure that you're just being smart with the rules.
Mm-hmm. Yep. Absolutely.
And yeah.
And some segue a little bit. Some questions that we've gotten recently, and I see on the Q&A here. What are the best accounts to invest in? Why don't you kick that off, Phil?
Yeah. So again, always very situational,
Mm-hmm.
right? We always try to get the pros and cons of each, especially as Pickle Pros, right? We're not going to tell you exactly what to do or where to do it, right? As coaches, right?
Mm-hmm.
But educating you what is out there, right?
Right.
So first off, when you're talking about investing, right, this is not talking about what we just had a previous conversation on, which was high yield savings or bank accounts.
Mm-hmm.
We're talking about either a brokerage firm, like a big box firm, like you all have maybe heard of, like a Fidelity, like a Vanguard, or even others, right?
Mm-hmm.
And or even like a private trust company, right? Where they're also a custodian, and these are all the term custodian. Now we're not cleaning anything up. It's not janitorial services, okay? Mm-hmm. Custodian just means they can hold investments, right? It's called custody assets, which is why they are called custodians, okay? And why that's important is they actually have quite a bit of insurance themselves. It's not called FDIC insurance always. They maybe have some portions of that in some parts of their business, but they have generally different levels of insurance for individuals depending on the company that they are.
Yeah.
I know one we use most in our financial planning practice is we use a private trust company, and right. This has never really come up too often because it's just not really a huge concern. But the last couple of weeks it has, right, with this bank thing, and a way a private trust company holds assets. And again, remember, they can hold any type of account, a Roth, an IRA, sometimes even 401ks. Or SEP IRAs, or even normal investment accounts, joint accounts, individual, etc. So it doesn't matter the account, but the way the money's held, if it's in a private trust company, it's in the general account, right? Meaning that your account itself does not commingle with the company's account. So whatever that private trust company is doing on their side doesn't matter for your assets. Whereas sometimes a brokerage company, when you're putting your money to a bank and or like a brokerage company, they can actually be using your money for other things, Mm-hmm. So again, it's something that you should worry about, especially as big box custodians or companies. But in this day and age, there are sometimes some better ways to hold assets than others.
Mm-hmm.
Yeah.
Absolutely, very very good point. And what type of account specifically to use? You rifled off a lot of them. It is unique to everybody's situation. A lot of it is based on time frame of when you can leave the funds in there. If you need access prior to 59 and a half, okay. 401k probably isn't that type of account that you want to put that money into, because you'll get a 10% penalty if you pull it out prior to 59 and a half. So it's based on when you want the account accessible, your current tax rate, potential future tax rate, that will kind of dictate if you're doing traditional IRA versus Roth. If you're self-employed and don't have access to a 401k, things get unfortunately more complicated. You're now living in the solo 401k or SEP IRA world, which are a little bit different, totally different contribution limits. Our average caller, right, just maybe has a 401k. And maybe they get a percentage match, so you probably want to consider doing that first, and getting the free money from the employer, and then investigating some other accounts and kind of ordering some based on longevity of how long the account's going to be around and
priority.
But that definitely is very specific. It's definitely not a blanket statement of everybody should have this, everybody should have that. If you don't even have a match in your 401k. That depletes a lot of the benefit of a 401k in the first place. It's not the investment options that are unique to the 401k. A lot of times investments in a 401k are sometimes inferior as far as the selection goes, right, of what you could pick. You get the world is your oyster in an IRA. There's 27,000 mutual funds, give or take, in the market. There might be 20 in the 401k. Are you holding the best 20 in every sector? Most likely not. Not to say they're bad, you should utilize them if you get a company match.
Right.
But that's a common question that we get, and then we'll take one more question here from the Q&A, which is if you are you've got a low savings or interest rate, I should say, on a bank, should you consider moving into a high yield account instead? And you said this well. I mean. And I'm set up the same way as you, right? I use a big bank for checking, an ATM, a global bank, so they're always there. I'm probably, within 5 miles of an ATM at any point in time. I feel like no matter where I'm at in the world, that's normal checking and savings and whatnot. This could be a credit union, that's totally fine too. And then, any money that's going to be parked there as an emergency fund, earmarked separate, then, whether it's $5,000, $10,000, everybody should probably, have an emergency fund, maybe 3 or 6 months. I know you and I kind of abide by that rule. You can consider parking that in something high yield. There's a number of those, out there right now.
And Johnny, try to stay away from call them the gimmicky ones, right? And everyone has some sort of understanding what that is, right? If they're doing some games with how much you're going to get a little more interest if you spend X dollars, or it's a raffle, or I've seen some crazy ones in the last couple of years. Let's not do that, right? Let's stay away from the gimmicky ones, or the really fintech kind of just finance companies that have maybe come out, and stay simple, stay boring.
Fair, yeah. Fair.
Find the ones that have been around for the longest, and have the best track record.
Yep, absolutely.
So
well, great. Well, it was good chat off the cuff with you there on that stuff, and obviously, for anybody listening, if you want to call into Money Pickle, you might get Brandon. You might get me, you might get another Pickle Pro, but obviously we're here to strategize and talk about these things, more so on a personal level, and coach you through, just what is an ever more complicated, industry, I guess, just accounts and financial advice and things like that. So.
Yeah, these weekly summaries on hot topics, I think, are super good because, we get to hear it every day, but this is a platform for us to be able to share this with others about what happened this week and what things that people have been asking questions on. So thanks everyone for listening.
Yep, sounds good. See you, everybody.